Most people in this market are chasing memes and vaporware, looking for the next 100x multiplier. But while the crowd is distracted, one of the oldest giants in DeFi is quietly printing more cash than almost anyone else. Yet the price chart hasn't fully caught up to reality. We are looking at a protocol that just announced balance protection up to $1 million for users and is generating nearly $200 million in annualized fees. The fundamentals are screaming growth, but the weekly chart is compressing into a tight coil. The question isn't if Aave is a good project. The question is, are we about to see a massive repricing event, or is this consolidation a trap before a lower low? I am looking at a specific technical setup that suggests a violent move is coming. If we lose the $125 level, the thesis breaks. But if we hold here, the upside targets are significant. Right now, Aave is trading around $180. If you look at the last few weeks, it feels frustrating. We have seen rotation into other sectors, but Aave has been stuck in this choppy range between $150 and $200. Market sentiment is currently mixed. We are seeing high volatility, and traders are hesitant to commit capital to older altcoins when new shiny objects are launching every day. However, this boredom is exactly where opportunity usually hides. While the price action looks stagnant, the on-chain data paints a completely different picture. We are seeing a massive divergence between the value the protocol is capturing and the price the market is assigning to the token. Usually, these gaps eventually close. The market can stay irrational for a while, but it cannot ignore cash flow forever. But before we map out the trade setup on the weekly chart, you need to understand the fundamental catalyst that could be the fuel for this technical breakout. What changed my perspective on Aave recently wasn't just a chart pattern, it was a shift in their product strategy. We are seeing the launch of the Aave App. For years, DeFi has been scary for normal people. Clunky interfaces, confusing wallet connections, and the fear of losing everything. The Aave App is attacking this friction head-on. They are positioning this not just as a trading tool, but as a high-yield savings alternative. They are advertising rates up to 6.5% on stablecoins. Compare that to the 0.4% you get at a traditional bank. That is a massive spread. But the real game changer here is the balance protection. They are explicitly marketing coverage of up to $1 million per account. This addresses the single biggest objection retail investors have regarding DeFi: safety. When you look at the data from Token Terminal, the dominance is already there. Aave is currently the biggest lending protocol based on USDC deposits, with nearly $6 billion deposited. That is real liquidity, not wash trading. There was a great post by Spacebyte that summed this up perfectly. They noted that Aave looks like a quiet storefront with empty tables, so people assume business is dead. But behind the door, the kitchen is running at full capacity. The income statement backs this up. In Q4 of 2025, projections show fees hitting over $180 million. The protocol is printing earnings in the green, while many competitors are operating at a loss just to acquire users. This is the disconnect. The token price reflects sentiment, which is neutral, but the engine reflects behavior, which is bullish. This fundamental backdrop, high revenue, new retail-facing app, and massive stablecoin dominance, is why I am interested in the chart. But fundamentals alone don't tell you when to buy. For that, we need the technicals. By the way, if you are interested in how to actually utilize platforms like Aave to generate that passive income, or how to navigate liquidity pools without getting wrecked, I have compiled all these tactics in my DeFi guide. It covers everything from wallet security to yield strategies across the major protocols. It is available in the pinned comment for just $4.99. Now, let's break down the weekly chart to see where the smart money is positioning. We are zooming out to the weekly timeframe because that is where the signal is strongest. Noise on the 4-hour chart is irrelevant for a trade of this size. The first thing that grabs my attention is this dotted orange ascending trend line. This line has been acting as the spine of the entire recovery since the lows of 2023. Every time price has touched this line, we have seen a significant bounce. We are currently interacting with the general zone of this trend line again, which tells me the long-term trend remains intact as long as we stay above it. However, we are also dealing with a descending trend line coming from the local top of $385 in August. We had retests in October and November, and both times the price got rejected. This creates a compression pattern. Price is being squeezed between rising support and falling resistance. Typically, when volatility compresses like this, it is followed by a violent expansion. Given the underlying uptrend, the probability leans toward a bullish continuation, but we trade levels, not feelings. Let's look at the moving averages. The price is currently sitting above the 200 simple moving average, which is the green line. Holding the 200 weekly is the baseline requirement for a bull market. However, we are trading below the 10 and 21 EMAs, as well as the 55 and 100 EMAs. This cluster of moving averages right above our heads at $200 to $250 is acting as immediate dynamic resistance. We need to reclaim these lines to confirm momentum has shifted. Now look at the Heikinashi RSI indicator at the bottom of the chart. This is crucial. Every time we have seen this white circle print, indicating a reversal from bearish momentum while in oversold territory, it has marked a local bottom. We saw it in early and mid-2023, we saw it recently in April, and we are seeing the setup curling up again right now. This suggests the selling pressure is exhausted. I'm also watching the volume profile on the left. The point of control, the price level with the most traded volume, is all the way down at $85. That is our worst-case scenario magnet. However, there is a volume gap between $115 and $140. If we lose the current support, price could slice through that thin air quickly. For my Fibonacci retracements, I am anchoring from the swing high of $385 down to the swing low of $115. This gives us our roadmap. The 236 level is at $178, which is exactly where we are fighting right now. The 382 resistance is up at $217. That is the breakout level. If we clear $217, there is very little structural resistance until the golden pocket at $280. So, how do we trade this? I'm not blindly aping in, I'm executing a level-based plan. My load zone is strictly between $150 and $200. I view this entire consolidation range as an accumulation opportunity for the next leg up. As long as we are inside this green box on my chart, I'm comfortable building a position. However, every trade needs an invalidation point. For me, that is a weekly close below $125. That represents the red dashed line on the chart. If we lose $125, we have broken the market structure, we have lost the ascending trend line, and the probability of a flush down to $80 increases significantly. I'll cut the loss there and look to re-enter lower. Now for the upside targets. This is where the risk-reward ratio gets attractive. I'm setting a trailing stop strategy. My first take-profit target is $280, which aligns with the 618 Fibonacci level. At that point, I will trim some exposure and move my stop loss to my entry price to make the trade risk-free. My second target is a retest of the local highs at $385. If we clear that, we enter price discovery for this cycle. The 1618 extension sits at $552. That is a major psychological level. Beyond that, the 2618 extension is at $824, and the 3618 is at $1,095. Reaching $1,000 might sound aggressive, but remember, Aave has traded over $600 in the previous cycle, and the fundamental revenue engine is stronger now than it was back then.
To summarize, Aave is a fundamental beast that is currently sleeping on the technical chart. The launch of the consumer app and the massive revenue figures provide the fundamental floor, while the weekly technicals show a coiling pattern at trendline support. I'm betting on the convergence of price and value. The market is ignoring the cash flow right now. But once the technical breakout happens above $215, the repricing could be swift. I'll be updating this chart in real time as these levels get hit. If you want those updates faster, make sure to join the free Telegram group linked in the pinned comment. And if you want to see another setup on a DeFi infrastructure play that is showing similar strength, check out these videos on your screen. Thanks for watching, never financial advice, and I'll see you in the next one.